this law of compounding is so powerful, which is why the wealthy never sell. So how do they get wealthy? How do they get the money? How do they buy things? How do they buy houses? How do they buy cars? Well, they use assets as collateral, the collateral layer. So assets are not something I buy and sell. Assets are something that I use as collateral. Collateral for what? Collateral for more assets. Let's break this down. What we want to do, what the wealthy do, is they think about what collateral do I have? What is my balance sheet wealth? And how do I activate that to grow more wealth? So again, the old game was very linear, right? So I have income, I work really hard, I work 40 hours a week, I have a side hustle, I'm working 50 hours a week, I have income, I then pay tax on that money, I lose 30 to 50% off the bat. Then I pay for my life. Gets expensive. How do I live after I've paid taxes? That's hard. Then hopefully I invest a little bit after that, right? But again, if my income suffers, then I have to start selling this. Or if I want to get the house or I want to get a new car, send my kids to college, I have to start selling my assets, and all this starts going backwards. That's the old way to play the game. But the better way to do it, the way the wealthy do it, like the way the 1% do it, they play a different game. And what they do is they earn income, but they use the income to buy assets. And because they have assets used as collateral, they get this tax efficient, which means that they can buy assets without paying a lot of tax right here. Then they use the assets to pay for their life. That means even if their income stops, the assets are still there compounding, and they're continuing to pay for their life. It also means that they never have to sell the assets to lose the compounding to pay for their life. Now, again, how do they do that? Well, they use it as collateral. Collateral for what? They use collateral for equity, for liquidity. So here's how it works. If I have a house and it's worth $1 million, but let's say that I have $400,000 of equity in that house. That's dormant capital. That's lazy, inefficient capital. This house is going up, let's call it at 5% compound annual growth rate. Whether this 400,000 is in the house or I take the 400 out of the house, either way, it's going to be 1 million at 5%. That doesn't change. But what I could do is I could take this 400 out of the house and use it for whatever I want. I could use it to buy more assets, buy some stocks. I could use it to buy some gold. I could use it to, of course, buy some Bitcoin. I could use it to pay for my life, to buy a new house. And this money comes out tax-free because it's not income, it's liquidity. It's debt that I'm pulling out against it. Now, if I pulled 400,000, I bought some stocks, some gold, and Bitcoin. Now, let's say I have 200,000 sitting in Bitcoin, and that's now going up at, call it 20%. But now there's equity here, 200,000 of equity. So if I need to pay for my house payment, I need to pay for a new car, I have liquidity I can pull out of here. Again, I could take some of this 200,000 out, not as income that's taxed, where I lose half of it, but as debt. And then I could use it to buy another asset. And so what the wealthy are really doing is that it's a completely different way. They're buying assets to use as collateral, and they're using money, equity and credit, equity to buy another asset. Asset 2, and use some of that to buy asset number 3, and some of it to buy asset number 4. Now, if they have a house going up at 5%, they have stocks going up at 17%, they got Bitcoin going up at 25%, their blended return rate is 200% plus higher than if they had just bought a regular asset. So they're stacking vertically instead of horizontally.